Hey guys, thanks for tuning in. This is the Will and Cody show. Will and I were just talking about all the new Instagram followers that we just got in the last week. I think it's about 80 of them.
Yeah,
so we want to say welcome, guys. Thank you so much for tuning in and listening to us, giving us a shot. Maybe give you some good financial advice. We actually got. We were doing some this new strategy for getting followers on Instagram that we found from Gary Vee. If you ever heard of him. He's Gary Vaynerchuk is his full name, but Gary Vee is a great social media guy, guru,
he's
I guess.
The man. Yeah.
He's awesome.
Yeah.
And so the strategy is called the $1.80 rule. So you give your 2 cents worth, which I'm very good at, and do it 90 times on numerous different hashtags. It works for Instagram. We're trying it on Twitter. It's not moving as fast, but we're giving it a shot. And it's pretty awesome. So we got 80 followers. So thanks, guys, for
just trying to interact.
Give it a shot.
Yeah, trying to interact more. Rather than just us posting stuff and kind of leaving it up there, we're trying to interact with other people's posts. Stay involved with it they're doing, because there's a lot of other people that are posting good content. So try to give our response, our feedback to that. And engage with different people. And so I think it's kind of
know if we agree or disagree.
Right. Exactly. So just kind of sharing that rather than just, posting and leaving it there. We want to actually engage with others. And so we've seen, pretty good results pretty quickly with that. Yeah. And so I think that's what we're going to keep trying to do going forward and hopefully keep seeing some growth. So if you're joining us from, if you're a new follower and joining us, so thanks for jumping on. Thanks for listening. And maybe there's a lot of other episodes that we've done before, so feel free to check those out as well.
Mm-hmm. Yeah. And if you're listening right now, share it, whatever on social media or anything. Just share the show, share the content. We really appreciate it. It helps us out to get that out there. And one of the best ways to grow an audience is word of mouth and sharing on social media. So please do that. That we would really appreciate it. So, Will, last time we looked at some tweets, and I got a cold reaction from you. But I was informed that you agreed with all of them, and that they weren't very disappointing.
We got to be more controversial with the tweets that we're sharing. Yeah. So, because last time I feel like it was pretty easy to agree, so I tried to tweak some of them. But yeah, you never know with cold reaction. So hopefully, Cody, you picked a little bit more controversial ones. We'll see what I have to say this time. But
yeah, I think a few of these you're going to agree with. It might be one or two. You might be like, I don't know about that. But maybe it'll get you thinking. So let's go ahead and look at this. I've got, and I'm not going to say the name again, just so that way I don't want to
we're not putting anybody on blast today.
I'm sure you could search it and be like, oh, that's the person they were talking about. Yeah. But anyway, that's not my problem. So. And I got to log in back in my phone. My phone's about to die. All right, here we go. You ready?
Mm-hmm.
If you're early in the process of fixing your finances, keep it simple. The more complex your system, in quotes, is, the more likely you are to quit.
Man, Cody, I'm going to have to agree with this one. I'm going to have to agree because I think it's true. I think if you get too complex too quickly, you'll get burnt out. And I am really good at this. If I want to start something, I set really lofty goals for myself, or I make a complicated system and then I do it for a week and that's it. And so I'm really good at that. If I want to start, eating healthier or working out, I'm going to work out all the time. I'm going to eat the best, super healthy. And then I last a week. So I think being simple, so know what your goals are and know what you're shooting for, and not try to do too much at one time, I think is a good way to go. I think if you have unhealthy things you're doing, okay, you may need to tackle a lot of those. But as far as new habits that you want to build, or if you're, just starting out, I think simpler is a really good way to go. And then being able to repeat that consistently, is kind of a key, rather than taking on a ton at once and then you're going to quit, after, a little bit of time. So I'd have to agree with that. I think you slowly kind of build on with that.
All right. We're just warming you up. Okay. Here we go. I think this one you're going to agree with as well, but I'm just going to go ahead and get it out of the way. Investing is 5% intelligence and 95% control of emotions.
Okay, I agree with the principle, what they're trying to get at. I think their ratios are way off though of that.
Yeah.
I feel like, I mean, you could throw it in garbage and be very good about controlling your emotion. You know what I mean? Like you have to know at least somewhat what you're doing. So I think 5% is way too low for that. Cause I mean, if you invest in terrible things, but you're really good at keeping your emotions in check, like you're just going to be in terrible things. So I feel like if you have some sense about you, I don't think you have to have a ton of knowledge. So I think it's a low percentage. I think if you just have enough knowledge to know that, okay, I need to put it in the right things, but I'm not, not somebody that has to be like a technical trader. Okay. You don't have to have that much knowledge, but at least to know, okay, mutual funds, index funds, it's a good way to go. I'm going to put it in that, and then control of your emotions comes in. But yeah, I have to raise the percentage on knowledge.
What kind of so you like a 60-40 or 30-70? Like what are you thinking?
Trying to think what I would say. Yeah, I would say closer to like a 60-40, what I would say. Because or maybe even 30-70. Like you have to have a good idea of what to put it in, what to invest in. And then a big part after that is controlling your emotions. I feel like,
right.
So I think that's a greater percentage because even if you invest in the right things, but you can't control your emotions and you're just going to, go in and out. Sorry, my video was doing something weird. But I think, even if you're invested in good things and then you just take your money out, it's not going to be as worthwhile to you. So same in reverse, but I would say the 60-40 or 70-30 would be the ratio I go with.
Gotcha.
And there was actually an interesting study done by, I forget which group did it, but they were basically looking at returns, and the investors that had some of the best returns long-term were investors that forgot their password to their investment account or forgot that they had the investment account. Like that was literally some of the best returns, was just people who literally couldn't check or couldn't change their balance.
Wow.
Yeah.
I've never heard that. That's great.
And so it was super interesting.
Makes sense. I mean,
like long-term, people that invest in the right things and then literally can't log into their account do the best.
So the investment strategy is create an account, invest, create a password, and throw it away. Don't remember it.
Yeah, that's pretty good.
I mean, it works, right?
It would work.
All right, so let's look at the next one here. This one's interesting to me, because I get what it's saying, but I don't know. I haven't put enough thought into it. This is why you're getting the cold reactions, not me. Because then you would say the tweet to me, and I would just sit here like with a dull face forever. Just like,
gotcha.
Like this, I wouldn't know what to say. So anyway, I've been thinking on this one for a little while, and my phone went dead again. So just a sec. It's like low battery. Anyway, okay. Paying off your debt does more for your mindset than it does for your finances. Don't at me.
Don't at me. Okay. Paying off debt does more for your mindset than it does your finances. This is a tough one to react to.
Right.
Without heads up. Okay. I think I think is the last one. They've got the right idea. I think also it's really good, like, to not have consumer debt for your finances. Like that's a huge thing to be in the positive instead of the negative as far as net worth. So I would maybe say, mindset is a part of it, but I don't know if it's greater than not being in a financial hole where you're having, the high consumer interest rates working against you, like on credit card debt or, car payments, stuff like that. So I would say, I think they're trying to get to a right place where they're saying, hey, it's also a mentality thing. And I think it is. You're getting momentum working for you instead of against you. So by paying off those, consumer debts with high interest rates, you're, paying those off, you're getting momentum going, and then you can just flip that momentum into starting to really get investing.
Mm-hmm.
So I think they get the principle is right. I don't know if I would say it's more than just purely financial. I think it's also a big financial thing to, paying off debt. So I don't know if it's, as much as they were saying, but I think the principle, they got it, but I don't know if I would follow the rest of it.
Yeah, that's kind of what I was thinking.
Yeah.
It was like, it basically the way the tweet was, I don't know if this is what they meant, but it was like, it really wasn't that important. Like debt wasn't that important. It was just more about like this freeing spirit. And then,
that's kind of how I read it. Yeah, that's kind of how I read it as well. That's how I received it. Yeah. And so I don't know about that. Yeah.
Yeah. But I'm thinking like, I get it though. Like paying off debt, like it's a huge like weight off your chest, and
yeah, it's huge.
Just to be able to accomplish that. Like I don't want to belittle that, but it can mess you up financially.
Yeah. So, you're doing it for the financial goal. So I think, that's kind of the main motive, and then it also helps your mindset.
Yeah.
Yeah.
Cool. All right. Let me look at I got two more. I think one you're going to agree with and one you're just going to not like at all. All right. You ready? Okay. Friends today. Why do you invest so much in Bitcoin? 5 years later, how did you get so wealthy?
I mean, for some people that may be true. Or it's like, I don't know. I think Bitcoin's a little bit controversial. Or at least, somewhat, it seems like.
This is why I chose to tweet.
I don't have as much, big a deal with it. I think it's fine. Yeah, I don't know if I would put all my eggs in one basket, as it were.
Yeah.
So that's what I would say about that tweet, at least, of like, I wouldn't say the success of Bitcoin is literally I'm all in. You know what I mean?
Mm-hmm. Yeah.
I think there's other things that need to take place for that. So I would say as part of a strategy, fine. If you want to do a small portion, into that, I would particularly do a very small portion, or I currently, don't have anything, in that. But as far as saying that was what your investment success was riding on, is that one thing,
mm-hmm.
I would say that's probably not the way to go, but that's just, that's my 2 cents. So,
so that's why I chose that tweet. So going into that, I know you wanted to talk a little bit about asset allocation. And so that was kind of the tweet I want to end with is you explaining, say, because Bitcoin, I guess it's a cryptocurrency, but you could see it as like an asset.
Yeah.
But we wanted to talk a little bit about, like, we talk about diversification a lot, and there's this thing called asset allocation. It's basically like almost the same thing, but not really, but kind of is. And that part is like blurred in my head. So Will's going to explain it to me, and he's going to teach it back to me.
That was such a great description. If you want to know anything in finance, just say it's like, but it isn't. That is so good. Like, it's like it is, but it's not. That was amazing. So
we're gonna do one of those like things where it's like me standing like this is like a quote.
Yes,
it's like right at the bottom. We're doing
right under you. Yeah, so it's like a finance definition, and it's you posing, and then it's just gonna give like a dictionary definition, and then it's gonna be underneath our definition. It's gonna say Cody says it's like it is, but it's not.
But it's not.
That's so good.
That's great. Okay, I'm gonna put a note to do that.
So asset allocation is a strategy that basically, if you think of investing in different types of assets, and then if we look specifically at stocks and bonds, there's different types of stocks, and we would say usually you can break them down by sector or by what kind of stock they are, or what the goal of a company is. And so the basic principle of asset allocation is you want to diversify. So there's your word, Cody, between different asset classes and asset types, so that if, depending on which one goes up, you can still benefit from that. So there's a chart that a lot of financial people use, and it's called a jelly bean chart, just because I know it sounds weird to say that in finance, but basically it's a color coded chart, and it'll show, every year. So it's, years in the columns, and then different colors will be each like asset type. And then it'll show how well each asset type did in that year. So if it's did really well, it'll be at the top. And then you can, see it bounce around from year to year. And so that that chart will demonstrate that, different asset classes will do varying degrees every year. So one thing could be the top performing asset class that year, but it could also be like in the bottom 2 years later. And so the basic principle of asset allocation is, well, if you don't want your investments to be like a roller coaster, always going up and down to the extreme, and you kind of want to level it out, well, what a great way then, just to balance it out between those different asset classes. And so instead of just putting all your money in one, as we just said with Bitcoin, what happens if you put a little bit or a medium amount in a few different groups, thereby spreading around your risk? And so, yes, if one goes really high, you may not make as much if you put all your money into it. Okay, it's true. It's the reward. But also you reduce the risk. So it's that classic risk reward ratio of you're spreading out your risk, but you're also still giving some upside, for the reward, just maybe not as much. And so that helps level out your return, over the long term versus it going up and down all the time. So I know I've said a lot with that, and I may have lost a few people listening, and hopefully I didn't lose you, Cody. So the basic principle is, if you think about stocks, you'll have a large cap, which is large companies. So large capitalization, large market capitalization. You'll have small cap, small companies. Makes sense, right? And then there's varying degrees. You could also have growth stocks. These are stocks that usually don't issue a dividend or as much of a dividend. They like to take any money that they earn and funnel it back into the success of the company. So they're trying to grow the stock, increase the share price. Versus a dividend stock, which is, a company that, okay, we did well that year, we want to issue a dividend, which is like a payment out to our investors. So do you see the different styles? So that, depending on that, the company can, do various degrees of success. And then you can also think, versus US versus international stocks. And then you could think stocks versus bonds. So you see all these different categories. So you don't have to be in, all of them in particular, but having a good mix of a lot of them gives you that, what we would call asset allocation. And then the principle with, that a lot of like financial advisors would use that you may go and talk to is they would set it up based off of your risk tolerance. So based off of, usually it's like a survey or an analysis they'll do to say, see what your risk tolerance would be. And it's pretty standard across, most financial advisors. And then from that, we'll determine what percentage they're going to put in each asset type. So it used to be back in the day, they used to say, take your age and subtract it from 100. And that is usually the percentage of stocks versus bonds. Now, again, I think times are changing a little bit. I don't think bonds are worth quite as much what they used to be, but that used to be the thing. So if you were 20, you should be 80% stocks, 20% bonds. Now, again, I think that changed, but just to give you an idea, that's what it used to be. Right. Quite a few years ago. So usually the higher your risk tolerance, the more percentage would be in things that are a little more volatile. So they're going to move around a little bit. And then as you decrease risk tolerance, so you adverse to risk, you don't like it, you would obviously invest more in stable things. So once that's set up, you have, your risk tolerance, your percentages. So say you're at, 10% bonds, you've got, and then the rest 90, you've got split between, let's say international, small cap, large cap, and then maybe like, some dividend stocks or something like that. Just throwing out some examples here.
Right.
you've got your percentages set so that as years go on, say bonds aren't doing as well. So you look at your percentage, your stocks are now worth 92% of your total portfolio and your bonds are worth 8. Well, they used to be at 10, right? And so what happened then is called like rebalancing. And so you would just reset, shift in your buying of what you own to get back to your percentages. And usually that helps ebb and, the kind of the ebb and flow of different assets. Right. If one's doing really well, okay, that might be time to start to sell. So you start selling some of it. And if one's low, that's a good time to buy because it's pretty cheap. And then you kind of balance everything out. And so I know I've kind of rambled. I think there's a lot to talk about with that. Yeah. So I just realized as I got into it, because then I got to get into, risk tolerance, and then you got to get into rebalancing and all that kind of stuff. But that's the basic principle is you're diversifying, but across different asset or asset types. So that's the basic principle. So as Cody so awesomely said, it's like diversification, but it's not. So it's not.
So if you say, let's say one of our listeners is listening and they're like going to get into investing, or maybe they're already like in an index fund or mutual fund or something like that, how can they take what you just taught us and apply it, or should they?
So I'd say a good way to do it. So you're looking at, index funds or mutual funds. There are going to be a lot of different types. So what I would look at is I would pick different types. As I mentioned, I would pick, okay, let me find a good mutual fund or index fund for international stocks. Okay, found one. Let me find a good one for US. Maybe, or in US, you want to do, large cap stocks. So I'd find one that says it's for large cap stocks, and it's a mutual fund or index fund that has a lot of, those type companies. And so what's great is when you buy an index or mutual fund, goes back to diversification, right? You're buying something that's already diversified within that sector or within that asset type. So you're buying a diverse group of those kind of stocks. And then I would say, you want some small cap, stocks in there. If you want some dividend or like growth and income funds, or, a good old just S&P 500 index fund that maps that is a really good option for a lot of people. And so I'd say once you get a few of those sectors and you feel, confident with it, that's a good way to diversify. But then also think, so you're diversifying from an asset level, and then also you're diversifying by buying into index or mutual funds that have a bunch within them. So it's like double diversification, if you will.
Gotcha.
So rather than just saying like, oh, I need to buy, international stocks. All right, I'm going to go buy two stocks that I heard of that are international companies. Well, that may not, be as well as if you just bought an index or a mutual fund. So what I'm saying is, when I say buy that asset class, buy an index fund that's or mutual funds that is, and it'll say in the name, it'll say this is what the stocks are that we're investing in. And so it makes it pretty easy. So that's what I kind of say with the takeaway, of that.
And correct me if I'm wrong. I mean, aren't there some like mutual funds that kind of already do this for us? Because I know mutual funds are managed. And so that manager could be potentially doing that asset allocation already, and it could already be something kind of doing it for you.
Yeah. So that is an option. Some people, another one that you'll see is like target retirement funds. And that's what it'll say. So it'll say target and then a date. So like, it's going to be a 20, like 2060, that's a far one out, or like, 2030 retirement account, and it'll have the asset mix is if you were planning to retire in 2030. And it'll, manage that asset allocation for you and all the rebalancing and that stuff that I mentioned, and even the risk analysis, it'll kind of map it out towards that retirement date. The only thing I would say
as you go,
the only thing I'm going to say is those are going to be some higher fees, since it's actively managed and, they're going to be doing all that adjustment for you. You're going to have to pay higher fees for that. So I would look at it. That's why I would just prefer, you can kind of change it on your own as you kind of go. If you're the one like, hey, I don't want to worry about this, I would just look at the fees, because usually they're going to be a lot higher than just buying, the index or mutual funds in each sector itself.
Right.
So I would look at the fees, definitely.
Wow. I feel so educated. I learn something new every day.
I feel like I talked a lot.
I remember when we did our internship, like I remember like a very detailed, but like you mentioned it too. It's like, hey, we should talk about asset allocation. I was like, what is that again?
Yeah. I just think it's good. And so if nothing else, if you just remember, okay, when this is when me and Cody, we talk about, buying different types of mutual funds or index funds. And you're like, I don't know what I'm looking at. I don't know what to buy. When we say that, we're really saying pick some good ones that seem to have a good track record in a few different sectors. So, and that's what we mean by, different asset types. So pick some in, that are large companies, and it'll say in the, the index fund. Buy some that are maybe, if you want some tech exposure. I know a lot of people that do that, break that one out as technology companies. Okay, I want, to buy some that are like that. You can find index funds that'll say we're investing in technology companies. And there's a lot of, pretty good ones that do that. And so buy a good mix, and then, you should be set. I mean, I think it's, pretty good way of investing. You're not picking and choosing, individual stocks or even individual sectors. You're saying, okay, I'm going to own a little bit of quite a few groups, and you're going to do well in the long term.
Mm-hmm.
So,
yeah. And there's just about an index fund for everything.
I mean, really anything.
Just go on iShares or Vanguard and just search something. You want to be like, okay, I just want technology, or I just want like cars, or just want like, there's an index fund for just about anything.
Yeah. And I'd say somebody that, if you're investing in your 401k, open up your, your 401k site, whoever it's through. And I'll just say mine. So I'll, it should be the same for yours. Mine will even have the list of mutual funds, and you can break it out by asset type. So I literally, when I, went in and choosing what I want my 401k to be invested in, I literally selected that, and it says, okay, here's all of our bond funds. Here's all of our large cap stocks. Here's all of our small cap stocks. Here's all the international, it literally just laid it out, and I was just like, okay. And I choose which ones I want.
That was like sliding and
yeah. So there's a lot of, options that are like that, where it'll already have it broken down for you. And I would just say, just choose one from most of those categories. You don't have to do every single one, because, you don't want to be in like 20 or 30. I mean, it won't hurt, but, I think choose a few good ones, that seem to be doing well. Yeah.
Yeah. My dad's IRA through TD Ameritrade, it was the same thing. It had like 6 different index funds through iShares. Because I was looking, I was thinking, I'm like, oh no, I'm curious what his IRA looks like. It was actually doing like really well.
Yeah.
And he was telling me about it, and I was afraid that it was a little too much.
Yeah.
In one thing, like growth stocks, or something like that. And I was like, oh well, that might be good now, but what is that going to look like, in a couple of years? So I looked at it. It's actually very well diversified. It's a very nice system. I mean, he can make any adjustment he wanted over, kind of whenever he needed to. But he just chose a plan that TD Ameritrade had. He's just like, yeah, I want to retire, hit the retirement button. And it popped up a recommendation. He's like, yeah, I'll do that. I mean, it's not that hard.
Yeah.
And you may want to adjust. You may be more like us, and we're like, oh, I kind of want a little bit more of this, or kind of want a little more of that. But if you open up an account with E-Trade, TD Ameritrade, I don't think Robinhood, but places like Vanguard and iShares and stuff like that, like they've got so many, just funds that they're managed, and that people have already done all this thinking for you. So really, there's no excuse. Like, just go invest. Like, please.
Yeah, do it. And I'd say, I've heard before that, maybe, I understand something different than you might. So if I explain this whole principle of asset allocation, and you're like, I have no idea what this man is talking about, feel free to message us, please. Don't sit there wondering, go look it up, or reach out to us, just say, hey, I didn't get it. And we will happily explain. And maybe I could find a different way to explain it than just hear us talking. so please don't, don't quite understand it. I think it's a good principle, of as far as how to diversify, and how to invest. And I think it can keep things, super simple.
Yeah. Yeah, definitely. I mean, even if you guys disagree with us, like we just want interaction, we just want to have a conversation. That's all we're doing. We're just educating. So, doing our best. So yes, sir. Let's talk about right quick. We're actually already at our 30-minute mark, but I think we can spare a little bit more time.
Yeah.
We want to talk about just a little bit about updates on our lives, just kind of what we're looking at, what our possible investments are, just kind of our goals financially or other goals. I mean, I have a goal of running a marathon this year. I don't know if it's going to happen, but that's a goal. So now I told everybody,
you
hey,
said
guys
it
have
out
to keep me
loud.
accountable. Yeah. It's out loud. It's out there. So keep me accountable, please. I need help.
Yeah, it's out there. So we got to hold you to it now.
Yeah.
Things for me. Let's see what I got going on. My wife is doing some spring cleaning, so that is always fun. Going through all of our junk, and we always realize how much stuff we have. And so, we've found quite a few things we think we're going to sell, which is always a plus. So we're found a ton of stuff that we threw away, but also some stuff we're going to sell. So we're going to see if we can make a little bit with that. Other than that, I'm, been focused on my job. So I've been, just working a little bit more, and then, but still keeping my goals of, investing in for, retirement. So I'm still doing my 15%, as we kind of preach, doing that. Mm-hmm. And then also some extra funds I've been pushing towards saving for a down payment on a house. That's a goal, a goal my wife and I have. So we're trying to get ahead on that. And hopefully, if the, market starts to, go down in the next few years, we'd be in a position to, hopefully be able to get into a good starter home. So that's something we're saving up for. And then something Cody and I have been talking about recently, thinking about starting, and then, I've been talking it over with my wife, is I think I'm going to take some of the extra money that we got, from stimulus checks and tax returns and, end of year kind of stuff, taking a little bit of that and starting a new kind of fund for us. So we have a short-term fund for things like, an extra car or a car replacement, or, saving for a down payment on a house. That's more short-term stuff. I'd say now in 5 years. Mm-hmm. And then we're still doing our 15% towards retirement, but we really don't have anything for now for between 5 years and retirement. We really don't have anything that's kind of focused on that area. So I'm thinking about taking some of this extra money that we were able to get, and instead of, either spending it or putting it towards another category, I think we're going to put it in a investment account. So just a taxable investment account, and investing it exactly as Cody and I just said, in some good index and mutual funds, spread out amongst, a few of the bigger asset classes for stocks, and then just kind of letting it sit and then adding money, if we want to later on. And so this would be a goal for basically between 5 years up to retirement. And so if it even grew enough, it would be a great, as they say, like financial freedom fund, which is, basically like retirement early. And so I don't know if I'd ever truly retire. I don't think that's going to be like a goal for me, but it could be, okay, I'm not quite 59 and a half to start taking out some of my retirement money. But I really want to focus on a passion, or I want to maybe not have to worry about taking a job that produces enough, for us to live off of. Now I have this money that I've been able to save and invest that I can live off of and start using before I'm able to access those retirement funds. So I think I'm thinking about starting that. It'll be very small. We don't have a lot of like extra money, that's not assigned to something. So it'll just be a little bit, but I feel like at least getting us started would be a good, a good place for us to be. Just instead of having nothing for that time period, I want to have at least something started.
It's a great goal
for that. So that's kind of
So
kind of what we're thinking about.
We've been talking, like just texting. He just mentioned it to me. It's like, dude, I'm thinking about like doing something beyond just what retirement. Because I mean, we could always like whatever extra, and I know exactly what he's talking about. It's like your margin's margin. It's like that bonus you didn't see coming, or like that stimulus check, or just something. Like you sell the TV, or you sell a car or something. There's always a little bit of extra sometimes, hopefully. And it's like, what do you do with it? Well, we could throw it into our retirement accounts, and that's cool. Because that's growing for us. It's you've got a Roth 401k, I've got a Roth IRA, and I think you got one as well. And that's growing tax free, so that there's a huge benefit to putting the money there. But you still can't pull it out till after 59 and a half. And so we've been thinking about that. It's like, well, what about the before? And I've always had this like idea in my head. It's like, I kind of want to retire at 50. I don't think that's ever going to happen, but I was like, I'd like to be like, I'd like to hit 50 and be like, dude, I could like quit my job. It might make the job more fun. Just like, I could quit anytime. It's like, you're going to make me mad. I'm just going to quit because I can't. Right.
Yeah. I'm just going.
I don't know. But then I was thinking like, oh man, what if it like, it grew enough and we could like buy a new or a nicer, bigger house, or maybe a new car, or just something, right? Just something. And so, we've been talking about that, and I think that's something we're going to do. We may kind of update everybody on that. But as far as recents, I mean, 15%, the same on the down payment on the house, because owning a home is definitely in my opinion, a really good goal to have. Just right now, like we've been looking, and the interest rates are like crazy low, but the prices keep going up, and so it doesn't offset enough for me to justify buying now. Nothing's really in our budget, and so and
things are getting bought up like crazy.
We were looking at one the other day, and not even a day later, it's on Zillow. Hours really, and I call them. It's like, hey, is this still a thing? And they're like, no, an investor just like he didn't even look at it, he just bought it. I'm like, I can't compete with that. Yeah. It's like,
that's kind of how it's going.
Maybe
right
when
now.
I'm 50, I'll be like that. But for now, I can't do that.
You be that guy.
I'll be that guy, but not right now. So, but we're just kind of saving for that. Yeah. And just keep chugging along. Work has been insane, trying to build a business. And we're going to talk a little bit down the road. We're going to talk about business because that's another kind of passion of ours. But we really wanted to hit home personal finance. So everybody had a good foundation. Something to reference, because in business, personal finance is actually it's linked more than you might think, or at least the way that we run business. It's very similar to how we run our personal finances, and so we thought we'd like to get that foundation. So, building that, it's crazy. We're breaking records in sales and stuff. So, been busy. But still trying to hit the Instagram. I was trying to help grow an audience. This is kind of an experiment for me because, I've always seen the people on YouTube and Instagram, Twitter, Facebook, and it's like, oh, that'd be really cool if I could become an influencer like that. And we're like in the baby stages, but I like to think we're influencers, right? Like we've got an audience, right? Like not yet.
I don't know if I want to be titled influencer, but I'll let you. Okay, that's fine. I'll let you have the title of influencer. I'll just be like that guy on YouTube or that guy on Instagram or something, whatever. He's that guy. I don't know if I'd take the title of influencer. You're
influential. You influenced me, right? Sure. Okay.
Sure. I'll take that.
But that's kind of that's it on our end. I mean, it's kind of the same old. Just chugging along, staying out of debt.
Yeah,
stay out of debt. Just trying to survive. Yeah, it is.
That's good stuff. Yeah, man. It's a grind, so just keep at it, and keep chugging along. So if you have goals as well, keep them up and keep going. And so we're still on pace. We're doing good.
It is a grind
where we want to be.
This is It's not like all the other guys on social media that's like, oh, I bought all these houses and I'm getting all this like rent money and all this stuff, and that's cool, but like our way is like really boring. I'm just gonna be honest with you. But it works, and that's why we do it. So So alrighty.
Yeah. Well, a lot of people want to make their money in 1 year.
I would love to do that, but it's so risky, and I'm like
a
guy that doesn't like risk at all. Like I want a proven plan. And like, you can maybe be a millionaire next year, or you will definitely be a millionaire in 30 years. I'm going to take the 30 year. So Yeah, for sure is nice.
I like for sure.
It is.
I like being confident in something.
Awesome. Well, we're right at 40 minutes, so I think we're just going to go ahead and wrap it up. Yeah, I mean, this has been fun. We appreciate it, guys. Thank you for listening. Please share. Please follow us on any social media that you're finding this on, and tell people. And go visit our website, www.willandcody.com. We've got a little contact us page. You can ask us any question you like. We'll feature it on the podcast. If you want to be on the podcast, I'll consider it. Mm-hmm. And we've got several things, social media. We do have a blog as well, if you want to check that out. And but yeah, this has been, I don't know what episode this is. I think it's like 12.
Sounds good.
It's like episode 12, I think. Yeah.
Something like
we
that.
appreciate it, guys.
Thanks for tuning in.
We'll see you next time.
Yeah. We appreciate it.